Gold, the timeless and revered precious metal, has captivated the attention of investors and market analysts worldwide. Its status as a safe haven asset, a store of value, and a hedge against economic uncertainty has become increasingly pronounced in recent years. As the global economy navigates a period of heightened volatility and geopolitical tensions, the role of gold in investment portfolios has taken on a renewed significance. In this comprehensive analysis, we delve into the latest developments and insights shaping the gold market. From Goldman Sachs' revised price forecasts to the intricate dynamics of central bank activities and shifting demand patterns, we'll explore the key factors that are driving the current and future trajectory of this coveted commodity. One of the most notable developments in the gold market is the revised price forecast from the renowned investment banking firm Goldman Sachs. The firm has raised its gold price target, now expecting the precious metal to reach the $3,000 per ounce mark by December 2025. This projection is based on a comprehensive framework that takes into account the current trends and underlying drivers in the gold market. According to Goldman Sachs, the primary catalyst behind this bullish outlook is the surge in demand for gold, particularly fueled by geopolitical tensions and the increasingly active role of central banks worldwide. As the global economy navigates a period of heightened uncertainty, investors are flocking to gold as a safe haven asset, seeking refuge from the turbulent market conditions. The increased demand for gold is a global phenomenon, with central banks leading the charge. These influential institutions are actively acquiring gold as a means of diversifying their asset holdings and strengthening their financial stability. This trend is part of a broader movement toward de-dollarization, where countries are seeking to reduce their reliance on the US dollar and bolster their domestic currencies. The impact of this heightened demand is evident in the volatility of gold prices. As central banks and investors scramble to secure their positions, the price of gold has been on a roller coaster ride, fluctuating rapidly in response to geopolitical events, economic indicators, and policy decisions. Goldman Sachs has identified key technical levels that underscore gold's upward trajectory. The firm highlights a critical support level at around $2,700 per ounce, as well as the 50-day exponential moving average, which currently stands at $2,630. These technical indicators suggest that the precious metal has the potential to maintain its upward momentum, with the $3,000 per ounce target remaining a realistic and achievable goal. Central banks have emerged as a pivotal force in the gold market, with their actions significantly shaping the direction of prices. The freezing of Russia's assets by the West, in response to the ongoing conflict in Ukraine, has amplified the importance of gold as a strategic reserve asset. This development has reinforced the belief among central banks that diversifying their holdings away from the US dollar is a prudent measure to safeguard their financial sovereignty. As a result, central banks worldwide are increasing their gold reserves, contributing to the upward pressure on prices. This trend is particularly notable in countries like China and India, which have historically been significant gold consumers and are now actively building their national gold stockpiles. While global demand for gold is on the rise, it's essential to note that the dynamics within individual markets can vary. One such example is China, where the demand for gold has shown signs of cooling in recent times. This shift is primarily attributed to the high gold prices, which have priced out some consumers, particularly in the jewelry sector. The economic challenges faced by China, including its ongoing battle with the COVID-19 pandemic, have also played a role in dampening the nation's appetite for gold. This development serves as a reminder that the gold market is not immune to broader economic and social factors, and the interplay between supply and demand can have far-reaching implications. Alongside the fluctuations in the gold market, the silver market has also been a subject of keen interest. One notable trend is the observation that when silver prices decline, significant buyers often hold back on gold purchases temporarily, allowing the price of gold to cool before resuming their buying activity. This dynamic provides valuable insights into the trading patterns and investment strategies surrounding precious metals. It suggests that investors and traders may use silver as a means of hedging their gold positions, taking advantage of the relative price movements between the two assets to optimize their overall portfolio performance. In times of economic uncertainty, investors often turn to hedging strategies to mitigate their risks. In the context of the gold market, this can involve selling other assets, such as silver, to offset the cost of acquiring gold. This approach allows investors to maintain their exposure to the perceived safety and stability of gold while managing their overall risk profile. These hedging strategies provide additional insights into the complex interplay between different precious metals and the financial instruments used to navigate the volatile market landscape. By understanding these dynamics, investors can make more informed decisions and better position themselves to capitalize on the opportunities presented by the ever-evolving gold market. The global geopolitical landscape has had a significant impact on the gold market, with heightened tensions driving increased demand for the precious metal. Events such as the Russia-Ukraine conflict, the U.S.-China trade tensions, and the ongoing Middle East unrest have all contributed to the perception of gold as a safe haven asset. As investors seek to mitigate their exposure to the risks posed by these geopolitical conflicts, they have turned to gold as a means of preserving their wealth and diversifying their portfolios. This surge in demand has been a key factor in the rising gold prices, with the metal serving as a reliable haven during times of global uncertainty. Another crucial factor shaping the gold market is the persistent challenge of inflation. As central banks worldwide grapple with soaring inflation rates, investors have increasingly viewed gold as a hedge against the devaluation of fiat currencies. The erosion of purchasing power has driven many individuals and institutions to allocate a portion of their assets to gold, as it is widely perceived as a reliable store of value. The inflationary environment has also influenced central bank policies, with many institutions lowering interest rates to stimulate economic growth. This, in turn, has made gold a more attractive investment, as the opportunity cost of holding the non-yielding asset has decreased compared to interest-bearing instruments. The appeal of gold as an investment has been further amplified by its role in portfolio diversification. Investors, both individual and institutional, have recognized the value of incorporating gold into their asset allocation strategies. The low correlation between gold and other asset classes, such as stocks and bonds, makes it an effective tool for risk mitigation and portfolio optimization. By including gold in their portfolios, investors can reduce the overall volatility of their investments and enhance their risk-adjusted returns. This diversification benefit has been particularly valuable during periods of market turbulence, where gold has often served as a stabilizing force in the face of broader market declines. The gold market has also been influenced by advancements in technology and innovation. The development of new financial instruments, such as exchange-traded funds, ETFs, and derivatives, has made it easier for investors to gain exposure to the gold market. These innovations have increased the accessibility and liquidity of gold investments, further driving the demand for the precious metal. Additionally, technological developments in the mining and processing of gold have also played a role in shaping the market. Improvements in extraction techniques, refining processes, and logistical operations have helped to optimize the supply of gold, ensuring a steadier flow of the commodity to meet the growing global demand. As we look ahead, the future of the gold market remains intriguing. While the current trajectory appears bullish, with Goldman Sachs' revised price target of $3,000 per ounce by December 2025, it is important to consider potential risks and uncertainties that could impact the market. One key factor to monitor is the actions of central banks. While their continued acquisition of gold has been a driving force behind the rising prices, a shift in their policies or a change in the geopolitical landscape could potentially alter the dynamics of the market. Additionally, the economic recovery from the COVID-19 pandemic and the normalization of monetary policies could also influence the demand for gold as a safe haven asset. Investors should also be mindful of the potential for market corrections and volatility spikes. The gold market, like any other financial market, is susceptible to temporary price swings and corrections. Maintaining a well-diversified portfolio and a long-term investment horizon can help mitigate the risks associated with such market movements. The gold market is a complex and multifaceted landscape shaped by a confluence of factors ranging from geopolitical tensions to central bank activities and shifting demand patterns. The revised price forecast from Goldman Sachs, along with the insights into technical levels, central bank roles, and hedging strategies, offer a comprehensive view of the current state of the gold market. For investors seeking to navigate this dynamic environment, staying informed and vigilant is crucial. By closely monitoring the evolving trends and dynamics within the gold market, you can position yourself to make informed decisions and potentially capitalize on the opportunities that arise in this ever-changing landscape. As the global economy continues to navigate uncharted waters, the role of gold as a safe haven asset is likely to remain paramount. Stay tuned as we continue to explore the latest developments and their implications for your investment strategy. The gold market's resilience and the strategic importance of this precious metal make it a compelling asset class worthy of careful consideration in any well-diversified portfolio.